Fusion Mobile, quality e-learning experience on the go.
You are welcome to Fusion Mobile e-learning platform. I'm also going to be calling me by name, the account tutor, and we will be treating reserves and provision in this class. And we'll be looking at the meaning of provisions, types of provisions, meaning of reserves, types of reserves, the differences between reserves and provision, bad debts and provision for doubtful debts, and also we'll be looking at provision for discount allowed and discount received. And the first thing we have over here is meaning of reserves. Generally, reserve a specific amount that is set against profit for a specific purpose. These amounts are usually set aside from profit to meet some specific liability or commitment that can occur in the future. For instance, it may be known that the bad debt, the amount of debtors in the future might not be able to be recoverable in the future, some proportion, but this proportion cannot be determined with an amount of with substantial accuracy. So we can make a provision on that amount which we know to not to be determined in the future. So that provision we can make from the deduction of the balance of the debtors is known as what? Provision, because we think that okay, a loss might come from the balance of the debtors in the future in such a way that some proportion of the debt might not be able to be recovered in the future. So we can make provision on that balance, which will stand as provision for that bad debt or doubtful debt, because the debt is said to be doubtful whether they are to be received in the future or not. Okay, we have the types of provisions. I said earlier, provisions are made against profits in order to meet some certain amount of liability or loss in the future or commitment. So types of provision, we have the provision for depreciation, we also have provision for bad debt, so we have provision for discount allowed. So provision can be made and discount to be allowed to the debtors. And four, we have provision for discount received. These are the type of provision we have in the book of account. Now let's move to the meaning of reserves. Reserve is the opposite of provision. This is usually said from profit of the organization, and this amount is set aside from profit not to meet any liability or commitment, but to build up the financial strength of the organization. This amount is not set aside to meet any form of liability or commitment in the future, but they are set aside to build up the financial strength of the business in order for the business to be able to meet some financial obligation in the future. So this amount will be set aside from the profit of the business, and this amount will not be available for distribution as dividends to the shareholders of the organization. But this amount will be set aside to build up the financial strength of the organization in order for it to meet capital projects in the future. So we have two types of reserves. Basically, we have two types of reserves. We have the capital reserve, and second, we have the revenue reserves. So the capital reserves. This capital reserve is a form of reserve which is not available for distribution as dividend to the shareholders. This type of reserve cannot be given as dividend to shareholders in the future, and this type of reserve includes capital retention fund, also includes premium on shares and debentures that become reserve, where we can get the capital reserve from. capital redemption fund, premium of shares and debentures. So you can also have it from surplus on revaluation of assets. If there's some revaluation on the asset, that can go to reserves. And number 4, we have excess of net asset over purchase consideration. And this type of reserve, the last type of reserve, which is excess of net assets over purchase consideration, can only arise when the business is to be acquired by another firm or when the business is to be sold. So capital reserve is going to arise when there is excess of net assets over purchase consideration. Okay, now let's go to the revenue reserves. Revenue reserve is the opposite of capital reserve. This category of reserve are available to the shareholder for this as distribution of dividends. They can be given to the shareholder as distribution of what dividends. So we can go to the difference between the reserves and provision. Differences between reserves and provision. The differences between reserves and provision. So we have reserves and we have provisions. Reserves serve as a measures of profits to the organization, while provision serves as a charge to profit. So this is a charge to profit. Why reserves contribute to the profit of the organization? It's measuring the profit of the organization. Now, the reserves also reserve is not to meet any liabilities in the future. So, while provision is to meet any form of liabilities or commitments, any form of liabilities or commitments in the future. So, when talking of reserves, reserve is an appropriation of the proprietor. So, it serves as an appropriation of profit to the proprietor. It is the part of the proprietor. So, reserve serve as an appropriation to the what? To the proprietor. Why provision is serve as a charge, serve as a diminution. Let's put it that way. Diminution or reduces the part of the what of the proprietor. Diminution to the proprietor. So it does not contribute to the proprietor. It serves as a charge to it. So that is the difference between the reserves and provisions. So we can go to bad debt and provision for doubtful debt. So we can move to the bad debt and provision for doubtful debt. The bad debt and provision for doubtful debt. Bad debt and provision for doubtful debts. So there's a lot of differences between the bad debts and provisions for doubtful debts. The bad debt is the unrecoverable debt. So it is the part of the what debtors balance that can never be recovered. So we term that as the bad debt. Is the irrecoverable debt, a debt that cannot be recovered. Now the provision for when the bad debt is created, so the double entry is for us to credit the account of the debtors and debit bad debt account. Thereafter, we transfer it to the profit and loss account by debiting the profit and loss account and crediting the bad debt account. So we also have provision for doubtful debt. As explained earlier, the doubtful debt serve as the provisions. So the doubtful debt also serve as the proportion of the worth of the debtors, which serve as an estimate or as the provisions that some balance of the debtors will not be able or may not be able to be recovered in the future. As a result of that, we are going to make provision on such an estimate. But such an estimate cannot, the reason why it's called an estimate, because that proportion of the balance of the debtors which may not be recovered in the future cannot be determined with substantial accuracy. So we have to make that provision by calculating an estimate, by calculating some proportion of the balance of the debtors, making some proportions, so that becomes provisions. So the balance of the debtors in which we think or that is doubtful to be bad in the future will be calculated as some proportion of the debtor, maybe in form of percentage or in form of ratios to be given. Again, entries in the book of accounts. So we have an illustration on bad debt and provision for doubtful debt or bad debts. Belumi Enterprises during the 4 years ended at the 4th December 1990, 1991, 1992, and 1993. The following debts were written off as bad. June 1991, 1,700 was written as bad. And to November 1993, so 1,250 was written as bad, and that. So on 31st December 1992, that debt remaining was 17,000. It was decided that provision should be 355 naira. On 31st December 1991, the total debtor was 25,000 and the provision was 680 naira. Again, on 31st December 1992, the total debtors remaining was 33,000 naira. The provision was to be 530 naira. And 31st December 1993, the total debtor remaining after bad debt has been taken out of it was given as 95,000 and provision was to be 750. Then you are required to be paid the necessary accounts. So, and the accounts we have to be paid in this situation is our bad debt account. We have to be paid provision for doubtful debt or bad debt account, while also we have to be paid the profit and loss account and the balance sheet. So we are going to, everything is based on an extract. So we are going to prepare the bad debt account. The bad debt account. So the double entry will be applied whenever bad debt is being created. The double entry is for us to debit the bad debt account and credit the debtors account. So we are going to maintain the bad debt account now by what? By debiting the bad debt account. So we have July 1990. So again, our debtor, how much? 1,700 was being written off. So this will be then be transferred to the profit and loss account. So by crediting, let me open the extract of everything. Let me open the extract. We have 1990. So we have June 1991. So we have September 1992. So we have November 1993. So that is all about that. So we can open our provision for bad debt. So we can open our P&L account, profit and loss account, an extract of the profit and loss account. That is the income statement. So then we can then open the balance sheet later. So we have 1991. Okay, 1990. The balance of this will be transferred to the bad debt account. So our amount of the bad debt, will be transferred to the P&L account. So what we are going to do to transfer this is for us to credit the bad debt account here and debit the P&L account. So come here, write December 1990. So write the P&L account, that is the profit and loss, with the amount of bad debts, 1,700. Come here, 1990. So we have our bad debt, the corresponding account which we are taking it from, then which is 1,700. Then we close that, close this, we close this. So that is the entry, double entry principle on that. So 1991 also we have a bad debt of 800 naira. So we're going to have debtor 800 naira. Then thereafter we transfer that to our what? Our P&L account. So we have December 1991 with P&L account, which is 800 to be transferred to P&L account. And come here, we have 1991. We're going to have our bad debt, so which is going to be 800. So 1992, we also have amount of bad debt to be 750 naira. So we do it the same way. We are going to debit the bad debt account with the amount of the debtor. So the amount of the debt that's been written off, 750, and credit the debtor account. That will be an invisible account now. So we have the 750. The next thing to transfer that the balance to the profit and loss account. So we have December 1992. So we have the P&L account, which is 750. So we transfer it here, 1992. So we're going to have our bad debt, which is going to be what? 750. So to be transferred. Okay. To be transferred. Okay. There should be some space because we can still have maybe provisions later. Let's still have maybe provision later. So 1991 bad debt, which is 800. 1992 bad debt, which is 750. So when we have provision, we can insert the provision there. So 1993 we have bad debt with debtor. We have to debit the bad debt account 1,250, and that's another the profit and loss account. It's going to be 1993, December 1993 P&L account. So we have 1,250 so to be transferred. So 1993 we have bad debt, so which is going to be 1,250. So the next thing is for us to prepare our provision for bad debt account or doubtful debt account. So in the following details, we were given that on the 1st December 1990, the total debtor remaining was 117,000 naira as at December 1990. So it was there to make a provision for 355 naira for us to prepare the provision for the bad debt account and provision for doubtful debt account. So on 31st December 1990, the total debtor remaining was 70,000. So it was there to make provision should be 355 naira. So we have to make the provision to be 355 naira. So while making the provision, so in 1990, so we have to what? Credit the provision for bad debt account and debit the profit and loss account. So we come here, P&L. In 1990, we credit the provision for bad debt account and debit the what? Profit and loss account. So we credit that with profit and loss account, which is going to be 1,700. So and come here, we have 1990, write provision for bad debts, which is going to be 1,700. Sorry, which is going to be 355 rather. 355 going to be 355. 355. Now the next thing is for us to balance the account in 1990. So come here, we have 1990. Since we don't have corresponding entry, we are going to have balance carry down. So 355. So in 1991, we're going to have balance brought down. So the new balance 355. So on 31st 1991, the total debtors was 25,000 naira. Provision was 680. So in 1991, there is no provision, which is going to be 680 naira. So we take that as our balance carried down. So as a closing balance of new provision to be made in the book, 680. So our balance brought down about 355. So we have an increase in provision for bad debt. So the difference between this and this, so the differences between the 680 and 355 will be taken to the P&L account. So the difference is 680 minus 355. So we have 325. That will be taken to the P&L account. 325. So we can balance 680. Then we can balance 680. So we can then have in 1991 we can have provision for bad debt. So we have 325, not 680 this time around. So we have balance brought down in 1992. Balance to be brought down is going to be what? 680. So here is a new provision in 1992 again. We have total debtor remaining to be 33,000, and the provision was to be 530. So that will be balance carried down in 1992. Balance carried down. So we have 530. So this is our decrease in provision for bad debt. So the difference is greater than this. So I have our P&L account here. So this decrease for provision for bad debt. So the decrease in provision for bad debt will be taken to the credit side of the P&L account as a profit. Why? It should be what? Debited to the provision for bad debt account. So P&L we are going to have what? We are going to have 150. So we have 680 already. We have 680. So this will be taken as what? As profit. So we have 1992. So we have provision for bad debt, which is decrease in provision for bad debt. So we have 150. So that's about the profit. So in the next year, we have balance brought down. So we can clean this so we can have some space. Balance brought down. So we have 530. So we have 530. So a new provision is okay. Is made in 1993 to be 750. So 1993 balance carried down. So we have 750. So this is also an increase in provision for bad debt. So the differences will be taken to P&L account. P&L. So we have 530 already. The differences will be taken to P&L account. 1993. So taking the P&L account, so we have differences will be going to be 20 and 220. So when added together, that give us 750. That give us 750 as the balance. So we are going to debit the P&L account 1993. So we have provision for bad debt. Provision for bad debt. That will be 220. So So we're going to have balance brought down, which is going to be 750 to the next accounting period. So this is P&L account. Do not forget this P&L accounts. So because of the space desired to us, just manage the space. This is debit and this is credit. So the next account to be opened is the balance sheet, the extract of the balance sheet. So we have to prepare the extract of the balance sheet. The extract of the balance sheet. Balance sheet is not an account. So we're going to have 1990. We have debtor. So balance of the debtors in 1990 is 17,000. So we are going to less provision for bad debt. Less provision in that year, which is 355. So we're going to less that 17,000 minus 355. That gives us 16,645. That is all about 1990. So 1991 we have debtor. So balance of debtor in 1991 is 25,000. So we are going to less provision in that period, which is 680. So the provision in that period is 680. That is 25,000 minus 680. That gives us 24,320. Thereafter, we also have 1992. We also have 1992. The balance of debtors in 1992 was 33,000. So less provision. So which is going to be 530. So we have 33,000 minus 530. So we have 32,470. Here also we have 1993. So balance of debtor then was 1993 was 35,000, and we are asked to make provision, less provision in that period, and that provision then was 750. So we have to less that to give us the remaining balance of the debtors in that period. So we have 35,000 and 750. We have 34,250. So this is the bad debt account. This is provision of bad debt account, the P&L account, and balance sheet extra. So this is the necessary account that is needed in the bad debt and provision for bad debt account. So in this class, we treated the provisions, the meaning of provisions, type of provisions, differences between provision and reserves, type of capital reserves. We talk about reserves. So if you are having any confusion with the topics, we play the video to be able to understand the topic more better. And again, some exercises will be displayed on the screen. Do well to attend the question. Thank you.